I predict that my next topic is going to make me millions. By the way, shout says to like and subscribe. So, number one, it is not Teladoc. I'm not a fan of Teladoc. However, this leads into my story. So first off, Teladoc, they had a boom during the pandemic. Look at that, $300 per share. All telehealth stocks exploded during the pandemic because people here forced to work from home. Everybody was working from home virtually. And what could you do? You couldn't go to the doctor's office, so you had to go to your online pharmacy, hence Teladoc. However, after the country and the world opened up again, just that type of online medication, online doctors, online doctor visits, and everything like that just plummeted. Just look at the stock from $300 per share to $11.48 per share. And this is not my stock. I'm not a fan of Teladoc stock. Why? Well, number one, Teladoc's revenue has stagnated from $2.4 billion in 2022 to $2.6 billion last year. That is very small. By the way, Shamao is eating. That's my cat. And just look, they're not even making money. It should be a simple business to make money from, you'd think, right? But look at their losses, $233 million in losses last year. So Teladoc has stagnating revenue and is severely not making money. In fact, the whole market is so bad, even United Health Group has exited the virtual health space, the telehealth space. They're gone. They said, no mas, no more, we're out. Even Amazon said, no more, we're out. And they switched to a chat-based service. Just everybody seems to be leaving the space because it's just not profitable. It's just not profitable. I don't blame them. I'm not a fan of the space at all. However, there is one stock that stands out. There's a diamond in the sea, in the rough. And that is HIMS and HERS Health. Now let me explain. First off, HIMS and HERS Health, current price is $16.88. Market cap, $3.6 billion. Actually, when I was buying, they were in the $2 billion range in market cap. I'll go over that in just a second. Now, what differentiates HIMS and HERS Health, ticker symbol HIMS, from the others? HIMS and HERS Health specializes in stigmatized medications. So they're telehealth, but for, let's say, you want to have hair loss, they focus on hair loss, weight loss, anxiety issues, skin issues, and probably their biggest product is, let's just say when little Jimmy isn't working, you go to them. Now, why focus on stigmatized medicines? Okay, let's say you have any of these issues. What are your options? You're 65 years old, you're having some or all of these issues. What are your options? Option number one, you can go to your doctor that you've been with for 20, 30 years, say, you know what? I ain't working down there. I'm having trouble in the bedroom. And you know what? A lot of people just don't want to do that. I wouldn't want to do that. I would avoid that like the plague. I would avoid that as much as I could because some things you don't want to go to your doctor for. And that's what they specialize in, is discretion. That's the whole selling point behind HIMS, is discretion. Because not only do you have the online pharmacy, but when this stuff gets delivered to you, it's just in a plain box. There's no indication what's actually in the box that you get shipped to you. It's complete discretion. So that's the biggest selling point. And that's why the others cannot compete. Teladoc can't really do this because they're generalized. Teladoc just says, you know what, we'll do everything. We'll cover everything. Everything you need, go to us. And that's their downfall, is they can't really advertise, they can't really specialize towards these stigmatized medications. The other thing that benefits Hims and Hers Health is the advertising, which I'll show you in a second. And they only carry a select number of medications. So there's inventory is great for them. Inventory throughput is great. They have very strong selling products. Every product that they own sells strongly. So they don't really hold on to inventory for long. Now, this is one of their advertisements. It says, should have done it years ago, and I feel like the young stud that I always imagined I was. Why do I bring this up? I bring this up because this type of advertising, Amazon just can't do it. Amazon Clinic cannot advertise like this. Teladoc cannot advertise like this. So this is I would call it their moat. Obviously, there's others that could enter this space, but this is what sort of separates Hims and Hers Health from the others. So how does Hims work? First, complete an online intake form to give your healthcare provider information about your symptoms and medical history. Then a licensed provider will assess that information and determine the right treatment for you. For states that require a video or audio visit, you'll be offered available times and dates to schedule your online visits. For states that don't, a provider will send your treatment recommendation to your chat inbox. If your provider determines treatment is right for you, it's delivered in discreet packaging to your shipping address. So that is that word, discretion. And that's from their website, by the way. And the other great thing about Hims is look at their balance sheet. Tell you what, I'll give you 5 seconds. How much debt, short or long term, does Hims have? 0. There is 0 debt. There's a little bit of lease obligations, but 0 debt. That is fantastic. And lots of cash. Lots of cash, 0 debt. So it's just an amazing balance sheet. Now, the other thing is, there's this new medication, I think it's called GLP. And what it does, it's a new weight loss medication, and it's taken the world by storm. There's 2 major suppliers for it, and it is in major shortages. And in fact, it's so popular that South Park did an episode on it. This is a clip from South Park's episode. So, what did Hims and Hers do about this? What they did is they went to their supplier network, and they went to one of their suppliers, a drug manufacturer. They didn't specify who, and they signed an exclusivity agreement to provide a generic for that medication at 85% less cost than Wegovy. So they're poised to take that market by storm because, again, these things are in very short supply. And they say, you know what? We're going to get you these injections at a far lower price. And that was announced just a week ago, actually after I purchased the stock. So it goes on to say, direct-to-consumer pharmaceutical startup Hims and Hers Health said it is selling injectable GLP-1 weight loss drugs for a fraction of the cost of brand name competitors such as Wegovy and Ozempic. Following the announcement, shares soared 30% last Monday. Hims and Hers Health will provide patients with compounded GLP-1 drugs that start at $200 per month. And that's going to be a high-margin drug, just like all their other drugs. And the rest you can read yourself. But yeah, you can see Wegovy costs $1,350 per month. That is so expensive. That's $16,000 a year without insurance, according to GoodRx. Hims and Hers may also be our competitors in another key metric, availability. The startup said its GLP-1 injectable drug, which is made in partnership with the manufacturer of compounded injectable medications, will have consistent availability. The company added that it will also sell brand name versions of GLP-1 drugs when supply rebounds. And actually, legally, they have to do that as well by law from the FTC. So, how is Hims' numbers? Let's get the numbers. So, as you can see, revenues exploded in 2020, 80%, 2021, 82.7%, 2022, 94%, dropping to 65% last year, and they're expecting 40% growth this year. So they're growing very fast. Now, as far as net income goes, just the previous quarter, the quarter previous to the last quarter, they finally became net income positive. This is what separates them from Teladoc and all the others. Remember, Teladoc was losing $230 million per year. Well, HIMS made $11 million last quarter, so they are net income positive, and this includes shareholder compensation. So this is the GAAP net income. So this is a huge milestone for them. And that is huge because, again, they're the only one in the space that is positive, cash flow positive and net income positive. Now, for the Q4 results, revenue is $247 million, up 47%. Subscribers is 1.5 million, up 48%. Gross margin, 83%. So yeah, I would call them tech firm margins. Net income, $1.2 million. Again, this is the quarter before last quarter. Adjusted EBITDA, $20.6 million. And cash and short-term equivalents of $221 million. Short and long-term debt, zero. 2024 outlook, revenue for Q1 of $267 to $272 million. Adjusted EBITDA, $22 to $27 million for an 8 to 10% adjusted EBITDA margin. For the full year, $1.1 to $1.2 billion. Adjusted EBITDA, $100 to $120 million. Yada yada yada. Another point of note is that long term, they're expecting adjusted EBITDA to be in the be in the 20 to 30% range. Now, this last quarter, Q1, the most recent quarter, the revenue was $278 million. So this beat their own expectations. They're expecting to higher the upper bound, $272 million. They reported $278 million, which is a 46% growth. As mentioned, $11.1 million in net income. Adjusted EBITDA, $32.3 million, which is, well, ignore the year-over-year numbers for that one. They weren't really profitable back then. Operating cash flow, $25 million. Free cash flow, $11.9 million. Subscribers, 1.7 million. So they went from 1.53 million subscribers to 1.7 million subscribers quarter over quarter. Monthly online revenue per average subscriber, $55. They didn't supply the growth on that one. I don't think they were reporting it back then. Here's a chart of their subscriber growth. It is accelerating at an exponential pace. So that is a fantastic number. Here's the net income chart. As mentioned, they are now net income positive and consistently growing revenues, which is fantastic. Here's their numbers and my projections. Now, according to my DCF, if their earnings just match their expectations this year of 40% and then crater to 25% next year, to 20%, 15%, 12%, 10%, going down to 6% by 2020 or 2033. If HIMS does these, in my opinion, terrible, absolutely terrible numbers, and here's a chart of those numbers, then in my estimation, their implied share price today should be $46.73. That, I think, is their intrinsic value if they achieve those numbers. And by the way, that is my base case. My base case. If you want to know my bear case or my bull case, head on over to my Patreon. Oh, and also, if you want to see the DCF model itself, I just showed you a couple of the highlights. If you want to see the actual model, head on over to my Patreon. I have a 7-day free trial. So the thing is, between the Q4 results, which were just barely profitable, and the Q1 results, Andrew Duda, which is their CEO, made a not quite wise post on X. So some context here, he is a Palestinian American. So this is obviously due to the Israel-Palestinian war. And he posted, moral degree is greater than college degree. If you're currently protesting against the genocide of the Palestinian people and for your university's divestment from Israel, keep going. It's working. There are plenty of companies and CEOs eager to hire you, regardless of university discipline. apply here, and then he sends a link to their application form. So this got a lot of attention, as you can see, 3.2 million views, and this got a lot of negative feedback, and this cratered the stock significantly, and that's when I bought in. I bought into the stock in my private Patreon portfolio. Again, you can view that on Patreon. So yeah, that's when I made my purchase into the stock, and that was in the short time period between this post came out, which was May 1st, and their Q1 results. So it's like a 10-day span. That's when I made my purchases. So the thing is, I prefer money over some moral issues or anything like that. Money always comes first. So with that said, Shamo says to like and subscribe. Thank you for watching, and I'll see you in the next one.